Apple is worth $3.7 trillion. Microsoft, $3.1 trillion. Nvidia, $3.3 trillion. These are the most valuable companies on Earth, but none of them owns the world. There's a firm you've probably never heard of that controls more wealth than all of them combined. As of January 2026, it manages $14 trillion in assets. That's more than the GDP of every country except the United States and China. And it doesn't make phones. It doesn't write software. It doesn't manufacture chips. It owns pieces of everything. This is the financial historian where money, power, and history collide. And nothing is ever as simple as it looks. The company is BlackRock, and it doesn't just manage money. It shapes how corporations behave, how governments borrow, and who gets to build the future. But here's the twist. BlackRock doesn't actually own most of what it controls. You do. Or at least your pension fund does. Your 401k. Your index fund. BlackRock is the middleman in a system where ownership has become so diffuse that power concentrates anyway. And most people funding it don't even know it exists. To understand how BlackRock became the most powerful financial institution on the planet, you need to go back to 1988. A bond trader named Larry Fink had just lost $100 million for his firm, First Boston. Not through fraud or recklessness, through a miscalculation on mortgage-backed securities. Interest rates shifted. The models failed. The losses mounted. Fink was pushed out. But instead of retreating, he built something new. A company that would never make the same mistake again. A firm obsessed with risk management, with data, with seeing every position, every exposure, every threat before it materialized. That firm was BlackRock, and its founding principle was simple. If you can measure risk better than anyone else, you can manage more money than anyone else. In 1988, BlackRock started with 8 employees and $30 million under management. By 1999, it had grown to $165 billion. By 2009, after the financial crisis, $3.3 trillion. By January 2026, over $14 trillion. That's nearly a 500,000% increase in less than 4 decades. No company in history has accumulated this much financial control this quickly. But BlackRock's rise wasn't just about smart investing. It was about becoming essential to the system itself. During the 2008 financial crisis, the U.S. government turned to BlackRock to clean up the mess. The Federal Reserve hired the firm to manage the toxic assets it had absorbed from failing banks. The Treasury Department asked BlackRock to value the securities no one else could price. BlackRock's software platform, Aladdin, became the backbone of crisis management. The platform tracks over $30 trillion in assets today across 240 firms, including central banks. That means when the Federal Reserve makes decisions about interest rates or bond purchases, it's using BlackRock's infrastructure to see the data. This isn't conspiracy, it's disclosed, public, and terrifying, because it means the line between government policy and private asset management has blurred to the point of invisibility. BlackRock advises governments on debt issuance while simultaneously buying that debt for its clients. And it manages pension funds while lobbying for policies that benefit those investments. The conflicts of interest aren't hidden. They're baked into the business model. And the business model is staggeringly simple. BlackRock doesn't pick stocks. It buys everything. The firm pioneered the mass adoption of index funds and exchange-traded funds, or ETFs. These products don't try to beat the market. They are the market. An investor buys shares in BlackRock's iShares S&P 500 ETF. BlackRock takes that money and buys a slice of every company in the S&P 500. Apple, Microsoft, ExxonMobil, JP Morgan, all of them. The investor owns a tiny piece of 500 companies. BlackRock manages it and charges a fee. The fee is small, usually 0.03 to 0.20% annually. But when you're managing $14 trillion, small fees become enormous profits. In 2024, BlackRock reported revenue of $18.6 billion and net income of $6.6 billion. The company has delivered a 21% compounded annual return to its shareholders since its IPO in 1999, compared to 8% for the S&P 500. Investing in the company that owns everything has been more profitable than owning everything directly. But BlackRock doesn't work alone. There are two other firms in this game: Vanguard, with approximately $12 trillion under management, and State Street, with around $4.7 trillion. Together, these three firms, known as the Big Three, control over $30 trillion. That's more than the combined GDP of the European Union, more than three-quarters of U.S. GDP, and their ownership is everywhere. Look at Apple's largest shareholders. Vanguard owns 8.7%, BlackRock owns 6.9%, State Street owns 3.5%. Combined, that's over 19%. Now check Microsoft. Vanguard 8.9%, BlackRock 7.3%, State Street 4%. The same three names, the same order. This pattern repeats across almost every major publicly traded company in America. A 2017 study found that the Big Three are the largest shareholder in 88% of S&P 500 companies. By 2021, that figure had reached 100%. Vanguard or BlackRock is the single largest institutional investor in 84% of those firms. This isn't a takeover, it's structural. As passive investing has grown, more and more money flows into index funds. And index funds, by definition, buy shares in every company in the index. The Big Three dominate the index fund market. BlackRock's iShares controls 29.4% of the equity ETF market. Vanguard holds 30.1%. State Street commands 14.8%. Together, they control 74.3% of all equity ETF assets. Every dollar that flows into passive investing flows through them, and with that money comes power. Shareholder voting power. When you buy shares through a Vanguard or BlackRock fund, you technically own the stock, but the fund votes on your behalf. Board elections, executive compensation, mergers, environmental policies, social initiatives. BlackRock and Vanguard cast the votes. And they don't always ask you how to vote. They decide, centrally, through corporate governance departments. William McNabb, former CEO of Vanguard, said in 2015 that anyone who assumed Vanguard's passive investment style meant a passive approach to corporate governance was mistaken. Nothing could be further from the truth, he said. As BlackRock's CEO, Larry Fink, sends annual letters to the CEOs of companies in which BlackRock invests. These letters set expectations. In recent years, Fink has pushed companies to address climate risk, improve board diversity, and align with stakeholder capitalism. Whether you agree with those goals or not is irrelevant. The point is that one man, managing $14 trillion, can move entire industries with a memo. Critics argue this is dangerous. That concentrated voting power in the hands of three firms undermines competition. That when BlackRock, Vanguard, and State Street are the largest shareholders in United Delta and American Airlines, they have little incentive to push those companies to compete aggressively. Why drive down prices and cut profits when you own all three competitors? The same logic applies to banking. J.P. Morgan, Bank of America, Wells Fargo, and Citigroup all share the same top shareholders. To technology, to pharmaceuticals, to energy. Defenders respond that the Big Three don't own the shares. They manage them. The money belongs to millions of individual investors, teachers, firefighters, retirees, people saving for college or retirement. BlackRock and Vanguard are just custodians, voting on behalf of clients, keeping fees low, providing liquidity, making markets work. Both arguments are true, and both miss the deeper point. The system has created a paradox. Ownership has been democratized. Millions of ordinary people now own pieces of corporate America through their retirement accounts. But decision-making has been centralized. A handful of asset managers exercise the voting rights attached to those shares. The result is a system where power is more concentrated than ownership. And the people with the power, BlackRock, Vanguard, State Street, didn't seize it. It was handed to them by investors seeking low fees and easy diversification. And the concentration is accelerating. In 2024, BlackRock acquired Global Infrastructure Partners for $12.5 billion, adding $116 billion in private equity assets. The firm announced plans to acquire HPS Investment Partners, creating a private credit franchise with approximately $220 billion in assets. BlackRock also purchased Prescient, a data provider, to expand its analytics capabilities. The company is no longer just a passive index giant. It's building a diversified empire across public markets, private equity, infrastructure, and data. Now, this matters because private markets are where the next phase of wealth concentration will occur. As more assets shift from public stocks to private equity, venture capital, and infrastructure, the firms that dominate those markets will control even more. BlackRock is positioning itself to be that firm, and it's using the profits from its low-cost index business to fund the expansion. Vanguard, by contrast, operates differently. The firm is structured as a mutual company. It's owned by its funds, which are owned by the investors in those funds. Vanguard has no outside shareholders, no profit motive beyond covering costs. This structure keeps fees lower than competitors. But it also means Vanguard can't raise capital the way BlackRock can. It can't issue stock. It can't make acquisitions funded by investor cash. It grows only as fast as clients invest. That's a competitive disadvantage in a world where scale is everything. State Street, the third member of the Big Three, is smaller and more focused on institutional clients. It pioneered the first ETF, the SPDR/S&P 500 ETF, in 1993. But it hasn't kept pace with BlackRock and Vanguard. Its assets under management sit around $4.7 trillion, significant but dwarfed by the others. State Street's influence comes less from size and more from its role in securities lending and custodial services. It holds assets for other firms. It facilitates trades. It's infrastructure. Together, the Big Three form a web, and that web touches everything: your pension, your mortgage, your government's debt, the corporations you work for, the media you consume. A 2017 study found that BlackRock and Vanguard are among the top shareholders in Time Warner, Comcast, Disney, and News Corp. 4 companies that controlled over 90% of U.S. media at the time. They don't control editorial decisions. They don't dictate headlines, but they own enough shares to influence board composition and executive incentives. And that influence trickles down. Here's what makes this system so insidious. It's not a conspiracy. It's not coordinated. It's emergent. BlackRock, Vanguard, and State Street didn't set out to own the world. They set out to provide low-cost, diversified investment products. Investors wanted those products. Money flowed in. The firms grew, and the structure of modern finance did the rest. Passive funds buy everything. Ownership concentrates. Voting power consolidates. The machine runs itself, and the machine is accelerating. In 2025, BlackRock reported record net inflows of $698 billion in a single year. That's more than the GDP of Switzerland. Vanguard's S&P 500 ETF saw $143 billion in net inflows in 2025 alone. Investors aren't fleeing passive funds. They're pouring in, because the alternative, active management, costs more and rarely beats the index. So money keeps flowing to the Big Three, and their influence keeps growing. What happens when 3 firms control this much? We don't fully know yet. The concentration is unprecedented. Some economists warn it could reduce competition. Others argue it improves corporate governance by creating long-term, stable shareholders. Politicians on both sides have raised concerns. Senator Elizabeth Warren has suggested BlackRock should be designated too big to fail and regulated like a bank. The House Select Committee on China investigated BlackRock's investments in Chinese companies linked to human rights abuses and military buildup. BlackRock's response is always the same. We follow the law, we serve our clients, we vote in their best interests. And technically that's true, but best interests is subjective. And when one firm's definition of best interests shapes the behavior of thousands of companies employing millions of people, subjectivity becomes power. The company that owns the world isn't Apple. It's not Amazon. It's not even a company in the traditional sense. It's a system. A network of 3 asset managers whose business model has accidentally made them the most powerful institutions in capitalism. They don't own the shares outright, but they control them. And in the 21st century, control is ownership. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.